is that even though this is a debt instrument, the prices of the bond in the market will fluctuate. And this will fluctuate based on whether there is a more attractive bond available at the same price. See, first that's all. So normally when we look at, like products in the market, we try to understand these products in terms of the price of the, like if let's say that I say that this is a toothbrush and the comparable thing with another toothbrush will be the price. Let's say these are two toothbrushes with the same quality, same function, everything. And I only look at the price to understand. But in the case of the bond market, you're looking at, so the prices are same. How do I distinguish between bond A and bond B? So I say that which one of them has a higher yield. So whichever has a higher yield, that bond will be more attractive. So in this example, what I was saying is that let's say that there is a 1,000 rupee treasury bill. That treasury bill is a bond. And let's say that if the coupon is 5%. So, and this bond is maturing in November 25. Now, it was issued in November 20. It's maturing in November 25. 5-year bond, 5% is the coupon. And I am going to pick this up in the open market in September 22. Now, the point is, when I am picking this up in September 22, what should be the price of this bond? Now, to understand the price of this bond, basically, I need to understand what is the most attractive bond available in the market today. What is the amount of interest that bond is giving me? So I'm paying 1,000 rupees for this bond. For the same price, can I get something which will give me higher than 5%? This is the question I need to ask myself. Now, suppose I look at this and I find that the government has issued a bond which has a coupon of 5.5%. So Anjali is here. That means I think I'll have to repeat this part. I think you'll bear with me, Lokesh.
Okay.
Anjali, are you here?
Yes, sir. Good evening,
Anjali,
sir.
Can you? Yes, sir. Okay. So today, I was just going to revise this part of that day's lecture where we were talking about the valuation of a bond, and I had just started to explain that. See, when you buy something in the market, normally suppose there are two things which have the exact same quality. Anything. Let's say there are two cars, they're equally good, everything is good. You like both equally. Today we are having, Hardik is here also, very nice. So, Hardik आ गए आप क्या?
हाँ सर.
ओके, चलिए. तो आज हम लोग ये बॉन्ड्स की बात करेंगे. बॉन्ड के बारे में आपको पता है ना, व्हाट इज अ बॉन्ड?
Yes sir.
हाँ, बेसिकली इट्स अ डेट इंस्ट्रूमेंट. इट्स इशूड बाय द गवर्नमेंट ऑफ इंडिया. हम लोग सब माने जो इंस्टीट्यूशंस है वो खरीद सकते हैं और उनको उस पर एक इंटरेस्ट मिलता है. एंड दीज बॉन्ड्स हैव अ सर्टेन रेट ऑफ इंटरेस्ट. जो इनका रेट ऑफ इंटरेस्ट होता है जैसे 5%, 5.5%, इसको कूपन भी बोलते हैं. ऑल्सो कॉल्ड अ कूपन. नाउ, अगर नॉर्मली आदमी क्या सोचता है कि अगर कोई बॉन्ड है मार्केट और उसका इंटरेस्ट रेट है 5% और ये 5 साल के बाद पैसे वापस दे दिया जाएगा, तो इट्स वेरी सिमिलर टू अ फिक्स्ड डिपॉजिट. इन दैट पर्टिकुलर केस एक चीज मन में आता है कि इसका प्राइस अलग अलग क्यों हो सकता है. एट डिफरेंट पॉइंट्स ऑफ टाइम, व्हाई शुड द प्राइस ऑफ दिस बॉन्ड बी डिफरेंट? अगर 1,000 रुपए इसका कीमत है, 5 साल के बाद इसकी मेच्योरिटी हो जाएगी, देन इफ आई वांट टू सेल इन द मार्केट, हाउ कैन इट हैव अ डिफरेंट रेट? So इसमें ये सोचना है कि at any point of time, if I want to buy a bond in the market from somebody who is the holder of the bond, let's say कि RBI issued a bond in November 20, उसका कूपन था 5%, ये बॉन्ड सितंबर 25 तक चलता था. सितंबर 25 में RBI will return that 1,000 rupees to you, and in between November 20 and November 25, it will pay you 50 rupees per year. That means that 5% it will pay. Now the question is, if I am going to buy this bond in September 22 from someone who had bought it in November 20 and now wants to sell it, ऐसा हो सकता है ना, किसी ने खरीदा November 20 में, September 22 आते आते he wants his money back, वो बेचना चाहता है. So who will be such a persons like this? They will be banks. Banks खरीदते हैं बेचते हैं, वो होते रहता है, depending on their need for money. अगर पैसा ज्यादा होता है उनके पास, they buy bonds. If they have less money, they sell bonds. Now, September 22 में, when I go into the market to sell this bond and somebody else comes to buy the bond, वो कैसे समझेगा कि इसका प्राइस क्या है? Is it going to be 1,000? Now, the way to understand this, and this is what you were saying last time, Anjali, that you are not very clear about. So the point here is, how do I understand what is the actual yield of a bond? क्या return मुझे मिलेगा अगर मैं इस bond को लेके इसको मैं खरीदता हूँ September 22. Now in this bond, ये November 20 में ये issue किया गया, September 22 के बाद से ये चलेगा up to November 25. And every year it is going to pay you interest. So in November 22, you will get 50 rupees. November 23, November 24, November 25, you will get 50 rupees every year. November 25, you will also get back your 1,000. ये पैसे, whoever buys this bond, he will get this money in the 3 years between September 22 and November 25. जबकि वो पैसे उसको वापस मिल जाएंगे. Now the question is, the person who is going to buy, he will say, I have to pay 1,000 rupees. I will get a bond which has an interest rate of 5%. Then in that case, is there something better in the market? Can I get something else which is available for the same price, but which has a higher coupon or a higher yield? And you find that yes, there is a bond that the government has issued recently, same price, 1,000. वो वाला bond में क्या है कि it is going to, it has a coupon of 5.5%. तो अगर उसका 5.5% and I buy this bond, then I am at a loss. घाटे का सौदा हो गया ना. I am paying 1,000 rupees. I will get 5% per annum. But if I buy this other bond of 1,000 rupees, I will get 5.5. तो ऐसा इसका प्राइस को कैसे एडजस्ट किया जाए? The question here is, how do we adjust the price in such a manner कि दोनों bonds का yield 5.5? How can I do? अगर हम थोड़े कम में अगर खरीदेंगे, 1,000 रुपए के चीज को अगर थोड़े कम में खरीदते हैं, then maybe अगर 50 rupees आएगा, तो it is equal to 5.5%. ठीक है, 1,000 रुपए देंगे, 50 रुपए मिलेगा, तो it is equal to 5%. लेकिन अगर हम 995 रुपया देंगे और तब भी हमको 50 rupees मिलेगा, then probably I will be getting 5.5 again. Exactly कोई figure होगा ना, some price where the yield will be exactly equal to 550. वो कैसे पता लगेगा कि वो price क्या है? That is the concept of discounting. तो इसमें, this is how we will do it. This is your bond. You are buying in September 22. November 22, your payment, you will get 50 rupees. you will discount this by 5.5%. तो when I discount this by 5.5%, उसका actual mathematical calculation क्या होगा इसमें? It is going to be 50 divided by 1 plus 5.5, that means 1.055. अगर 50 को आप divide करते हैं by 1.055, you will get 47.39. Now in November 23, you will again get 50. Now since you are getting this, after 2 years, you will now discount it by 5.5% squared. तो वो हो जाएगा 1.1130. तो इसका वैल्यू प्रेजेंट वैल्यू हो जाएगा 44.92. November 24 में you will get 50. Now you will again discount by 5.5 to the power 3. So you will get 42.58. You will do the same calculation for the 50 rupees you receive in November 25 and the 1,000 rupees which you receive back in November 25. अगर ये सब को हम ऐड कर देते हैं, what am I getting? I am getting 982.49. This means कि this bond, if I buy it for 982.49, then effectively मेरा जो return मिलेगा इस bond से per year, it is going to be 5.5%. अब क्या हो गया कि whether I buy 1,000 rupee bond for, if I buy 1,000 rupee bond, I will get a return of 5.5%. If I buy a 982 rupee bond, there also I will end up with the same return because that same 50 rupees will be paid. So यहाँ पर क्या हो रहा है कि the market price of the bond will become 982.49. And in this way, these two bonds will now be equal to each other. This is the point. Are you people understanding this?
Yes, sir.
Yes, sir.
So this is how the market prices the bond. It will take the latest bond which is available. And then it will discount the future cash flows of the bond by this latest figure. And whatever you get, that will be the market price. So that all bonds have the same yield. That's the basic point. And they are all equal in the market. ठीक है? Now, इसमें what happens here? Here we're talking about if there is inflation, if interest rates change, then what is this whole problem with inflation and interest rates? What is the logic here? Now, पहला चीज ये समझना है कि bonds are debt instruments issued by the government or companies with a very good, अच्छी कंपनियां वो उसको ये कर सकती, इशू कर सकती है. इसमें there is no credit risk. अगर सरकार आपको एक बॉन्ड इशू करके देती है तो ऑब्वियसली उसमें कोई डिफॉल्ट का खतरा नहीं. वो हर हालत में they will give it back to you, so there is no risk. If a very good company issues a bond, there is very little chance कि it will default. So credit risk तो है नहीं. कौन सा रिस्क है आपके पास? There are two risks. One is the risk of inflation and the other is the interest rate risk. Inflation, all of us understand. Whatever money I will get by way of interest on the bond, that will have less purchasing power, so that will be less valuable. So inflation is eating into the return I am getting. Now what happens is, there is a theory in economics which is generally accepted. Why is there inflation? Because there is a mismatch between the amount of money that is circulating in the economy and the amount of goods which are available. पैसे क्यों होते हैं इकोनॉमी में? एक ही कारण है, to purchase goods. तो अगर मेरे पास में बहुत सारा पैसा है और let's say I have a very small amount of goods, then what will happen? The individual prices of these goods will increase, and that is what causes inflation. So अगर हमारा मनी सप्लाई बढ़ जाता है या मेरा प्रोडक्शन घट जाता है, तो what happens is there is a mismatch between the amount of money which is there in the economy and the amount of goods which is there. And when that happens, the prices tend to go up. Now, when the prices go up, what RBI's reaction is, let me reduce the money supply. If I reduce the money supply, then फिर से it will reach the correct figure and prices will come down again. Let's suppose you don't understand this also, just accept this point that the normal reaction of all central governments in the world, whether it is in the US, whether it is in India, whether it is in England, it is that if there is inflation, we will try to reduce the money supply. तो मनी सप्लाई हम कैसे रिड्यूस करेंगे? I will raise interest rates. If I suppose करो आपको FD का रेट हम बढ़ा देते हैं. Just think as an individual. Suppose बैंक आपको FD का रेट बढ़ा देती है. So there is an incentive for you to go and deposit your money in the bank. You will feel कि if I now go and deposit money, I will get a higher rate of interest. Therefore, I should deposit. And when you deposit money in the bank, money supply economy mein is going down. Similarly, if RBI increases its own interest rate, there is a rate at which, let's say, it is picking up money from the banks. That is called the repo rate. So let's say that they increase the repo rate or they decrease the repo rate. It is going to have an impact on the banks. Now, banks जो हैं वो जो interest on bond, banks खरीदती हैं bond from RBI. Now, if RBI increases the interest rate on bonds and gives a signal to banks, कि look, we are giving you a better rate, you can buy bonds. Basically, what will happen is, as banks buy more and more bonds, money they will pay to RBI, that money will go out of circulation, money supply will come down. This is the logic. Are you people understanding this?
Yes, sir.
Yes, sir.
Now, if you have understood this, basically then we just have to come to the next step. The next step is, RBI may issue bonds with a higher rate of interest. These are bought by banks and are traded on the money market. Money market क्या है? Money market is a wholesale market. It is a market where people can, banks especially, and public sector units, only institutions can function in this market. They say for people like us, what is the market where we can go? It is the capital market. Shares की खरीद बिक्री अगर हम कहाँ करते हैं? Capital market. But for a bank which wants money or which wants to invest money, they will go to the money market. Who will be the other players in that money market? They will be other banks, other public sector undertakings, and the RBI. So, वहाँ पर the amounts of money which are in question there are big amounts of wholesale. और दूसरा है कि it is a very liquid market. मतलब आप कभी भी कुछ भी बेच सकते हैं. If you have a financial instrument like a treasury bill or a bond, you can always sell it on the money market. There is complete liquidity. Now, इस market में, if the RBI now launches a bond which has a higher coupon, as we saw in the last slide, that is going to have an impact on the prices of all the bonds which are already there, which were issued in the past. हर साल RBI bonds issue करता है. इस साल inflation है, they issue bonds at a higher coupon. जैसे ये होगा, what will happen is that the prices of the other bonds which are already trading in the market, those prices will change. In the next slide, I want to show you how that change is going to come. So, what will happen is that the expected future cash flow of each bond will be discounted by the new rate to get their present value. Exactly वही process होना है, which we saw in the previous slide, where we used the September 22 bond as an example. So the impact of this is that bonds that have a coupon that is lower than the interest rate offered on bonds will have a lower present value. So we will see how this works. By the same logic, those bonds that have a coupon that is higher, उस केस में क्या होगा कि they will gain in price. Now let's say that RBI inflation आ गया और RBI says कि I will now raise my rate. I will issue bonds with a coupon of 6%. Now in that case, what will be the impact on the bonds in the market? एक चीज आप मान के चलिए कि the face value of each of these bonds is rupees 1,000. Now, a rupees 1,000 bond, जो कि आज से कुछ साल पहले इशू की गई थी, उसका कूपन है 5.5%. 2 साल में ये मैच्योर करता है. इसका जो अब प्राइस होगा, will it remain 1,000 or will it go down? See, you need to ask yourself this question. Now there is another bond. Yes, Anjali?
It will go down.
It will go down, exactly. Similarly, there is a bond with a coupon of 5.7%, 1 year maturity. Iska kya hoga? This is also likely to go down. Now, what about this, Anjali? There is a bond with a coupon of 6% with 3 years to maturity. What will happen to this bond? Will the price change?
This time the price might be changed.
See, in this case, Anjali, what you're seeing is that the coupon is 6% and the new rate is also 6%. So as far as this bond is concerned, there is no change in the environment. Everything is same. Therefore, there will be no change in the price. That is I'll show you in an Excel sheet also, just in a minute. Bonds with coupon of 6.3. Now, this is a bond which was issued some time back where the coupon was actually higher. It was 6.3. And now it is 6. Now, this bond, if you just look at it logically, this bond is the most attractive bond because the next best bond is coming at 6%. This bond, anybody buys it, he is going to get 6.3%. So what will happen with this bond? Chances are, not the chances, what will happen is that the price of the bond will go up. So I've just tried to give the cash flows here. In the case of this 5.5% bond, 2 years to maturity, in these 2 years, you will get rupees 55 each, and then you will get the 1,000 back. In this bond, you will get 57, 1 year to maturity. You will get 57 in the next year, and you will also get your 1,000 back. In the 6% case, there are 3 years to maturity. You will get rupees 60 each year for 3 years, and then you will get your 1,000 rupees back. And then in the case of this bond, 6.3, you will get 63 each year, and then you will get your 1,000 rupees back. So this is what is going to happen. Now, let me just take you to an Excel sheet just to show you what exactly is going to happen. Okay. Okay, so now look at this particular, this is the first one. So this is a bond with a coupon of 5.5% and it has a 2-year maturity. Now in this case, remember RBI issued a bond with a coupon of 6%. And what are the payments, future cash flows in this bond? You will get 55 rupees after 1 year, and then you will get 1,055. 1,000 is the price of the bond, 55 rupees is the amount of interest. This amount of money you will get by way of interest and principal from the issuer of the bond. Now, if I discount this by the new rate is 6%. So if I divide 55 by 1.06, I will get 51.89. And if I divide 1055 by 1.06 to the power 2, which is 1.1236, I will get 938.95. If you add these two together, you get 990.83. Now this 990.83 is the present value of the future cash flows. What are the future cash flows? It is these two, 1,110 rupees. This is my future cash flow. I am discounting it by the new rate which RBI has used, 6%. I am getting 990. So what am I seeing here? The price of the bond, like you said, Anjali, the price should go down. How much down? This is the answer. It will become 990.83. Is this point clear to everyone?
Yes, sir.
Okay. Now suppose I go to the bond which had 5.7% or iska 1 year maturity. In this case, what will happen? You will get 57 plus 1,000 after 1 year. 1,057. इसको आप discount करेंगे with 1.06, you will end up with a present value of 997.17. That means इसका भी market price जो है वो कम हो गया. It will now be 997.17. So basic principle is, if I want to know what will be the market price of the bond that I have, all that I have to do is find out कि कितने cash flows बाकी हैं future में, discount that by the new rate of interest, and you will get your market price. Basic principle is, if the new rate of interest, the new coupon is higher than the coupon I am getting, then I am going to see a fall in the market price of my bond. And the vice versa is also true. If I have a bond like this bond, 6.3%, then what will happen? In this particular case, I have something which is more valuable than the present bond. Present bond has a coupon of 6%. This bond which I possess has a coupon of 6.3%. I will find out how much money I am going to get in the future. I have 1 year to maturity. So I will get 63 rupees plus 1,000, 1,063. If I discount this by 1.06, I am getting 1,002.83. So basically what will happen is the price of this bond will go up. So what happens to this bond where there is no change? Anjali, this is that particular case where you were in slight doubt. In the case of a bond which has a coupon of 6%, 3 years maturity, there is no change in the coupon as far as this bond is concerned, because it was at 6% and the new rate is also 6%. So you see, when you find out the future cash flows for 3 years, 60, 60 and 1,060, discount them by 6%, you will end up with exactly 1,000. So basically what is happening is, by adjusting the price, I am making sure that the yield in the case of each bond is the same. That's all. Is everyone clear about this?
Yes, sir.
Okay. Now, if we look at this in the form of a little graph, it will probably be even more clear to you. So, suppose I go to here, this, look at this. So this bond had a coupon of 5.5%. As you can see, when I discounted the cash flows by 6%, this is the actual price of the bond, 1,000. When I discounted the 5.5% bond by 6%, I landed up with a price between 990 and 992. Okay, it is below 1,000. 5.7, I ended up with something like 997. still below 1,000. In the case of 6%, there is no change. It is exactly 1,000. And in the case of 6.3, it has increased price to 1,002 point something. So, you can see this here in this graph, how the discount, the new bond, the new rate which has come, how that impacts the prices of the existing bonds in the market. This is the basic idea which you have to understand. So any bond, I'm repeating this, any bond with a coupon which is less than the new rate which has been announced will generally lose value, and any bond with a coupon which is higher than the rate announced is going to gain in price. So this is how the interest rate affects the price of the bond. And when is the interest rate raised? When there is inflation. So this is the relationship between inflation, interest rate, and the price of the bond. Because ultimately what you are learning here is that if I want to understand how valuable something is, I have to understand it in terms of the future cash flows. If I know what the future cash flows is, if I know what the proper discount rate is, then I am in a position to find out what the price is. This is the basic lesson in all this. Now, what I want to show here is a little article which was there in Mint. Now, in this article, basically what they are telling you is that because of inflation in the US, what they began to do was that they began to sell the bonds that they had in the market. So there was a huge amount of bonds which the Central Bank of the US, the Federal Reserve, they had purchased from the banks at the time of the COVID pandemic. So when the COVID pandemic came, economic growth went down. So in the West, they said that what we should do is give money to our banks by way of like they can buy, we can buy the bonds that the bank, see, the money is not being given free. What you are saying is, you're telling the bank, you have so many bonds with you, sell those bonds to us, we will give you money. Now, with the money that the banks have, what they can do is, they can give new loans at low rates of interest. Fed also said that if you want even more money, you borrow from us. We will give it to you at very low interest rates, practically free of cost. Take that money, give it to people who are willing to invest in the economy. As more and more money flows into the economy, as more and more people invest in the economy, what is going to happen? There is going to be economic growth, there will be employment, and we will be over this whole problem which is created by the pandemic. This will go. Now, in this process, what the Fed did was that they pumped in almost $5 trillion into the market. So money supply increased. They were hoping that when we pump money into the market, gradually what will happen is that economic growth will increase, production will increase, and in this way there will be economic prosperity, but there will not be inflation. But unfortunately, ये गलत निकल गया। 2 साल के बाद, April 22 का report है ये, there was inflation in the US, and at that point of time, the Fed decided that let me begin to increase the interest rates, and also let me begin to get back the money supply which was there in the market. So at that point of time, what it basically did was it began to basically like sell bonds at the rate of $95 billion worth a month back to the banks. So every month it is selling 95 million worth of bonds to the bank. Bank, when it buys the bonds, it is giving money to the Fed, and in that way money supply is being reduced. So basically, the flow is like this. COVID pandemic happens. Federal Reserve Bank purchases bonds held by banks and pumps money into the market to give more funds to the banks so they can give loans and restart growth. First step. Then by April 22, economy revives a little, but there is inflation. So Fed begins to sell bonds so that they can restrict money supply. Remember, इसमें simple सा चीज है. If the Federal Reserve or RBI if the RBI purchases bonds, they are giving money, taking bonds. So money supply increases. If the RBI sells bonds, then what is happening? They are giving bonds, taking money supply will decrease. So increased supply of bonds leads to lower bond. More supply, less demand. I think this is the point where Lokesh, you were slightly, you wanted some clarification. I think this will clarify it for you. So as the supply of bonds increases, basically what will happen is that bond prices are going to come down. Low price will be in high yields, like in the case of bonds sold at a discount. So the impact of this sort of measure by the Federal Reserve is ultimately going to result in a reduction in the price of bonds and an increase in the yield. This is the basic concept here. Are all of you clear about this now? Valuation of bonds?
Yes, sir.
Yes, sir.
And in that case, we will stop this and we'll move on to the next section, which actually is the next section actually is about the valuation of companies. So we come here. Let me just open this slide. Okay. Now, see, in this section, we are looking at this concept of suppose you want to find out, let's say you want to buy a company and you want to find out what is the value of this company. How will you find it? This is the basic question which we are taking up here, in this section. Right now we were looking at a bond and we said that, how do I find this out? I look at the future cash flows, I discount the cash flows and I find out. Now in a company, what can you do? You can do that also. You can do that cash flow approach also, or you can do something else also. So we'll just look at these two ways of doing it. So you can either look at the assets that the company has and try to find out what is the value of these assets. See, this is, in a way of speaking, this is one of the more conventional ways of looking at the price of something. Suppose I want to buy a house. So I look at the price of the house. How do I find out the price of the house? I try to find out what is the price at which a house which of similar size with a similar location, at what price did this house sell in the market recently? And I say that if that house sold for 50 lakhs, then that means my house also will have a value of 50 lakhs. So what I'm basically doing here is, I'm looking at the market, I'm looking at my asset, and I'm trying to value that asset, and I'm trying to arrive at a fair value of the asset, and I'm saying that this is the value of the house. Now, in the case of a company, if I want to value assets, there are many values which I can think of. I can think of book value, liquidation value, replacement value, reproduction value, market value, fair value, and fair market value. So there are a number of ways of looking at valuing assets itself. Now, another way of valuing the company can be through its revenues. So here what I'm looking at is, what is the revenue that this company is likely to give me in the years ahead? So basically here I want to find out what will be the cash flow that I will get from this company, or to be absolutely correct, what will be the free cash flow that this company will give me in the years ahead up till it exists. So if I can project those cash flows, then I am in a position to make a valuation of the company. Now, one of the approaches which is very common here, which is very similar to what we did in the case of the bond, is to discount the future cash flows. So the challenge here is to project the future cash flows correctly and to use the correct discount rate. If you can do these things, the same sort of calculation that we did in the case of the bond, if you do it for a company with a few additional steps, you will end up with the price of the company based on its future cash flows. Now, other ways of doing this is to compare the company's, different, multiples, different ratios. Like let's say the PE multiple, the price earning multiple of the company with that of similar companies, and then try to understand whether this company is properly valued by the market, is it overvalued by the market, or is it undervalued by the market. So we can look at it in different ways. Are you people getting the basic point here? Assets or revenues?
Yes, sir.
हार्दिक समझ में आ रहा है ये चीज?
Yes, sir.
अंजलि?
Yes, sir.
Okay. Now, suppose I look at the first one. So in the first case, I can look at book value. So book value in India basically is the original price paid for the asset and less the depreciation on the asset. Am I right, Lokesh, out here?
Yes, sir.
So the book value of an asset will decrease as it ages. Okay, the book value of liabilities similarly reflects the at issue value of the liabilities. Now, since the book value of an asset reflects its original cost, it might be very different from the market value. Because आप यहाँ पे book value क्या है जो original cost था asset, you are starting there. If you bought this asset 5 years ago, 5 years ago you paid a certain price for this asset. For each of those 5 years, you charge depreciation. Today, the book value that you have is actually a reduced value. So it's an accounting value. Now, one way of looking at it is like this. I look at my total assets. I look at my intangible assets. I reduce the intangible assets from my total assets. And I also reduce my outside liabilities. Whatever I'm left with, I say this belongs to the company. This is the value of the company. Now, this by definition will be a very low amount because I am basically just looking at book value. Now, what is the purpose of this? If it is a very low price, if this is a price which nobody will ever agree to sell the company at this price, what is the benefit of this? The benefit is that basically it is going to be the floor price. मतलब इससे नीचे तो नहीं हो सकता है. This is the minimum price at which this company can be sold. What is the disadvantage here? So basically, one disadvantage is that you are basically looking at the original cost reduced by the depreciation, which will be very different from the market value of those assets today. आज के दिन में, if I were to sell this asset or try to replace this asset, the value of that will be much, much higher. So that means this method cannot be a satisfactory method. इस ये मेथड अगर हम यूज करते हैं तो जो कीमत आएगी कंपनी की या जो वैल्यू आएगी वो बहुत कम होगी and it will not be proper. Now let's look at Another thing, liquidation कब होता है company का? Anyone? Lokesh, can you just tell us about this?
So, I mean, when the company is bad position or selling time,
Okay, yes.
liquidation करते हैं sir. Whatever the assets it has, it will enter in. It will try to sell to clear the liabilities and settle the equity shareholders.
Okay. So let's say there are two situations. One is where the board of directors, they decide that voluntarily, let us wind up this company.
Yes.
So let us liquidate the whole company, sell the assets and close it. So in that particular case, you have time. You can gradually begin to sell. You can find buyers. It will work. In the other case, let's say that a bank has control of your company. You are unable to pay the bank. Now the bank says that I want to sell this company, I want to liquidate it. The bank goes to the court agrees, they appoint a liquidator. What will the liquidator do? It will come, it will try to sell the assets of the company in the open market, and it will be selling it one by one, piecemeal. It will sell it one by one, and whatever it manages to get, that will be the amount which you will get. Now, in this case, do you think you will get a very good amount?
You can't give guarantee, sir. Maximum you will be at loss, because once you say you are liquidating, everyone will ask the asset for the less price.
Yes, because the distress sale ho jata hai.
Distress sale.
It is a distress sale. So in this particular case, you are not going to get a good price. So here also the price that you will get is going to be a very, very low price. So liquidation is often at distress sale prices. Then sometimes liquidation takes place in a weak economic environment. Abhi ka time le lo. Jaise for example, COVID has, we have just been through a round of COVID, 2-3 rounds of COVID. Economy is not doing that well. इस समय में अगर कोई चीज बेचेगा, if you want to liquidate, तो लोगों के पास पैसे नहीं है. कहाँ से पैसे वो देंगे? How will they give you a good price for what you want? And there is one more problem also. Let's say that somebody is trying to buy the company itself. Then also he knows that if a company is going to be liquidated, the major human resources of the company, जो अच्छे लोग कंपनी में थे, वो छोड़ के चले जाए. उनको नौकरी बचाना है अपना. Why should they stay? They will leave. So all said and done, liquidation value में you are going to get probably worse than book value. तो ये भी एक बहुत low price. But this is also one of the many ways of valuation. That is why we touched this. Now, let us look at this one, replacement value. In the case of replacement value, what we are asking here is, suppose I replace all the assets that the company has, जो भी उसके पास आज है. Suppose I want to make something identical, and I acquire the same machines, the same factory setup, the same assembly line, everything is same. Whatever the company has, I get that. But what I do is, I upgrade it by using the current technology. Let's say that जो पहले factory जो बनी भी थी वहाँ पर, that was used, it was made of brick and mortar. It was a solid building. Today, if I make it, I can use a different type of iron sheets and things like that, where for the walls, where it will be better. It will also maybe be in every way it will be an improvement. It will look better also. It may be more durable also. So, but I can replace something which is there using modern technology. Similarly, machines वगैरह maybe I can replace this machine by the new models of the same machines. So that is replacement. इसका क्या value हो सकता है? So whatever is the value, I will say that this is the cost of the company. I take all the assets of the company, I replace all these fixed assets, I replace the other assets, and I finally say that yes, this is actually the cost of the company. ये भी एक तरीका हो सकता है. Now, something little similar to this is reproduction value. Reproduction value is actually, theoretically, this is something which is there. In practice, this is not going to happen. Because यहाँ पर क्या है कि आप कोई नया टेक्नोलॉजी भी यूज नहीं करेंगे. You are going to try to create an exact replica of the company that is there. So you will create a duplicate asset. You will not consider new materials, new technology, nothing like that. If you do that, what will be the cost of creating this duplicate company? वो क्या आएगा? Whatever is the cost, that can be considered to be the value of the company. कि भाई अगर इसको अपने से बनाते, this would have been the cost. Similarly, if I use replacement value, if I replace all the assets using new technology, if I do that, this will be the cost. So these are different values that we have. So we looked at book value, liquidation value, replacement value, reproduction value. These are all simple concepts of value. Why am I telling you this? Because these are the simpler ones. ये आपको समझ में आ जाएगा कि ऐसे भी वैल्यू हो सकता है किसी चीज का. And then we'll go to the more serious ones. Now, think of another aspect of value. एक intangible aspect, goodwill. Now, goodwill, इसका definition क्या हम देते हैं कि it is an intangible asset. कोई देख तो नहीं सकता ना goodwill. It doesn't have a physical shape. So it is an intangible asset that arises when a business as a whole has a value greater than the value of its identified intangible assets. तो business का value है, जैसे कोई भी method से हम value निकालेंगे. What will happen is that business, because of, let's say, the intangible assets that it has. See, one type of intangible asset is related to things like patents, copyrights, इस तरह की चीजें. जैसे दवाई बनाने का कोई पेटेंट. Now, if you have a patent to make a medicine, that means you have a monopoly. That medicine cannot be made by anybody else. Only you can make it because you have the patent. You discovered the way of making that medicine. You created the market for that. So now if I suppose I replace your company, I cannot replace your patent. That is an extra. So that will add to the value. Am I making my point clear here?
Yes, sir.
It will add to the value. So that is one aspect. Now, look at this other one. Now, in the case of goodwill, recently I came across a case which is very interesting, where one company valued the other company, big company, it buys a small company, pays a very good price, and it basically paid not for the products of the company or the market that the company had, it paid for the human resources that that company had. What they found was that this small company has a group of people, small group of, this is a software company, small group of engineers who basically can be put to very good use. They are good people and they understand the business. So they said, okay, we will buy the entire company. When we buy the entire company, all these people will become our staff. And we will use these people according to our needs. So the intangible in this case was human resources. And they used them to buy the company. Now, think of another case. What is the fair market value of a company? Let's say, इसमें conditions क्या हैं? The highest price at which a property will change hands between a willing buyer and a seller. जिसकी company है, he is willing to sell. And there is no compulsion. उस पर कोई जोर नहीं है, कोई distress sale नहीं होता है. Company चल रही है, he is willing to sell it. उसका कहना है कि अगर मुझे दाम सही मिल गया, तो मैं इस company को बेच दूंगा. Simple. जो seller है, he is willing to pay, provided he is given a full knowledge of the facts. इस कंपनी के बारे में जितनी चीजें हैं, obviously the owner of the company will know more about this company than anybody else. So the assumption in fair market value is that both parties know exactly what this company is. इसके strengths क्या है, इसके weaknesses क्या है, सब कुछ इनको पता है. There is no compulsion on any party. ना खरीदने वाले पे कोई compulsion, ना बेचने वाले पर कोई compulsion. Both of them will negotiate. In that negotiation, a price will emerge. Now, this will be the price which is acceptable to both. According to the buyer, he will say that yes, ये कीमत पर I can actually gain. And the seller will say, yes, this is the price which respects the value of my company. ऐसा अगर कोई price हो सकता है, this is known as the fair market value. ये समझ में आया हार्दिक?
Yes.
Clear? Lokesh?
Yes, sir.
Clear? Now think of something else, something slightly different. You think of a situation, the seller is not exactly willing to sell. And उस case में what will happen? In some cases, fair value is the amount that will compensate the seller for being involuntarily deprived of his profit. कभी कभी क्या होता है, this can happen in the case of, जैसे एक merger हुआ, दो companies जो हैं वो मिल जाते हैं. Promoters के लिए तो बहुत अच्छा है, they are willing to merge with the other company and willing to take advantage. लेकिन जो minority shareholders हैं, उनके लिए हो सकता है कि this is not a deal which is to their liking. So they are not willing exactly to sell. इनको willing आप कैसे करो? How will you sort of make it beneficial for them to sell? They are saying I will not sell. So you can tell them, look, you are not selling at this price. Maybe I can give you a better price because you have a certain, let's say, you are an old shareholder of the company. You are linked to this company. Now we are going to change this company entirely. You sell the company, you sell your shares to us. We will compensate you for this. So it is possible that the fair value here will maybe more than the fair market value. But it is a fair value because you are taking something from someone who was not willing to sell. बहुत ज़्यादा का फर्क नहीं है, but I think you can understand what I am saying. पहला केस में both parties are willing players. दोनों तैयार हैं. दोनों के पास में पूरी जानकारी है. एक फेयर नेगोशिएशन होता है, उस नेगोशिएशन में एक कीमत सामने आती है और वो बेचने के लिए तैयार. दिस इज वन सिचुएशन. दूसरे केस में क्या है कि बेचने वाला जो है वो तैयार नहीं, खरीदने वाला बाकी कंपनी खरीद चुका है, बाकी शेयर्स में उसकी सहमति बन चुकी है. ये वाला जो हिस्सा है इसमें तैयारी अभी बाकी है, अभी नहीं हो पा रहा है. सो हियर he may say that okay, I will pay you a little above, I will compensate you for taking these shares away from you. That price will be the fair. तो ये भी एक तरीका है वैल्यूएशन के बारे में सोचने का. Now let us go for another, let's try to understand this. एक कंपनी दूसरे कंपनी को खरीदने वाली है. Now how will the price be paid? See, normally when two individuals are there, and let's say that one individual is trying to buy something from the other individual, the normal course is you pay it in cash. या आप कैश देते हैं, जो दूसरा इंडिविजुअल से जो भी आप खरीद रहे थे वो आपको दे देता है. Let's say you're buying a house, he gives you the house, you give him the cash. It is an all cash deal. हो गया बात खत्म. Now, in the case of two companies, one way of buying the company is obviously you pay cash, value the company, negotiate, both parties are happy, and then you pay that cash to that company. ये लो भाई cash, give me the company. This is an all cash deal. दूसरा option हो सकता है कि I will not give you cash, I will give you shares of the new company. Company A is buying company B. The moment company A and company B are together, एक बड़ी कंपनी हो जाएगी A plus B. सारा कैपिटल दोनों का मर्ज कर जाएगा. दोनों का शेयर्स का एक वैल्यू निकलेगा. सो दिस पर्सन में से अगर ए खरीद रही है बी को, तो ए में से टू द शेयर होल्डर्स ऑफ बी कि लुक, इंस्टेड ऑफ कैश हम आपको शेयर दे देते हैं नई कंपनी, आप शेयर रख लो. आपके पास आज भी शेयर था, अभी भी आपके पास शेयर होगा. फर्क ये होगा कि नाउ द शेयर दैट यू हैव will be of a bigger company, and your future prospects will be much better with us. Stay with the company, don't insist on cash. तो ये भी एक तरीका. अगर if this happens, then we call it a share swap deal. ठीक है? Are you with me, both of you? All three of you? Anjali, are you here?
Yes, sir, I'm getting.
Okay. So what will happen here? The valuation of the target company is relevant in the case of an all-cash deal. Target company, the company which is being bought, it will expect some sort of premium also. After all, why should it sell? So they will say, okay, value my company, but give me something extra. You remember when we said that what is fair value? So somebody, you go and tell the guy कि भाई आप अपना shares मुझे दे दो. वो कहता है कि हम बेचना नहीं चाहते, कुछ एक्स्ट्रा दो तो हम बेच. तो similarly, the target company, see there are two persons here. One is the company which is acquiring the other company, acquirer company. The other is the target company, जिसको खरीदना चाहता है. तो the target company में से कि भाई कुछ एक्स्ट्रा तो मिलना चाहिए. I have set up this business. You are taking it away from me. Give me something extra. Some premium may be paid. Now, in this particular case, why will the acquiring company pay a premium? इसके कारण कई हो सकते हैं. So just think logically. If the acquiring company buys the other company, or let's say both of them are in the same business. Let's say both of them are making cars. Company, acquiring company जो है अगर दूसरा कंपनी को खरीद लेती है, what is going to happen? उसका सारा मार्केट इसका हो जाएगा. So they will gain the market share of the target company, and to that extent इसकी competition कम हो जाएगी. They will basically now face less competition in the market. These two car companies, let's say, were competing with each other. If they come together, they are now going to be in a position where that competition is gone because the company एक हो गई है. So there is an advantage in giving a little extra to the target company to eliminate the competition. उसके अलावा क्या होगा? If the acquirer company will get the whole range of products जो उस target company के पास already है, and it will get its market share, competition is reduced, जो उसके पास में extra assets हैं वो भी उसको मिल जाता है. So there are a number of reasons why a company which is interested in buying another company, that company may actually be willing to pay a premium. What you need to understand is, जब हम value निकालते हैं किसी company का, it is necessary for me to think of the extra premium also. So I am not only thinking of the asset value or the value of the future revenues, I am also thinking of an extra premium. ये भी हम सोचते हैं कि some extra premium may have to be paid. How much premium should be paid? This is a matter of negotiation. So whole teams of negotiators will be there representing both companies. They will sit together, and इस पे तो कितनी किताबें लिखी गई हैं how to negotiate in such a situation. और उसमें they will arrive at a price, and that price will include a premium. So this is one thing to remember here. Now, I just want you to understand this from a balance sheet perspective. Valuation of business, valuation of company. What is the difference between business and company? Anyone? Business जो हुआ, that is the operational part. So business, the operating activities of the company, the value of the operating assets. जो operating assets हैं, उनका क्या value? And company will include the non-operating assets also. Now, in many companies, one very big part of the non-operating assets is land, unused land. उनके पास में जमीन है, it is just lying there vacant. आज के दिन में उस जमीन की कीमत बहुत है. That particular type of land is a non-operating asset because it is not being used to produce anything. It is just lying vacant. It is lying there, but it has been bought by the company. Therefore, if a valuation of the company is done, you also have to value that land. That is one example. The company may have patents which are not being used. उस तरह का भी चीजें हैं, that will also have to be valued. So basically, when I say company, I am talking about the entire assets of the company, those which are being used in the day-to-day business of the company, and those which are not being used, but which are there, which may be used in the future. Is this distinction clear? आप लोगों को?
Yes, sir.
Yes, sir.
So this was the first thing. Now, let us look at this in the form of a small equation. Don't get psyched by this. Very simple thing. VC is value of company is equal to value of business, VB, plus value of non-operating assets. So I've written it here. So you start here. When the valuation is going to happen of the company, I am valuing two things. One is the business, one is the... So basically, I am valuing two things here. One is the business, one is the non-operating asset. Now, suppose I look at this, in a little more, I give more, components to this. So it will be value of company is equal to V subscript E, that means value of equity, plus VD, value of debt, plus value of preference shares. This is equal to my operating assets plus the non-operating assets plus current assets minus current liabilities. बात बराबर है ना, आप किसी भी वे में इसको देखेंगे, बिकॉज ये जो दिस इज माय लायबिलिटी साइड, हमारे जितने लॉन्ग टर्म लायबिलिटीज हैं वो यहां पर है. तो I can either look at my liabilities or I can look at my assets. So if I value my liabilities, इसी liabilities the balance sheet ना, इसी liabilities से हमने asset खरीदा. So basically what will happen is when I value it like this, I am immediately valuing the total assets of the company also. So, but उस total assets में यहाँ पर जो liabilities है, these are long-term liabilities. So from the total, I am reducing the current liabilities. तो हमारे जो smaller liabilities हैं, which are there, maybe there are some suppliers who have not been paid, some employees have not been paid, some overhead costs have not been paid. तो ये जो liabilities हैं, इनको हम reduce कर देते हैं value से, because these are payable. And that gives me the total value of the assets. So basically what we are doing here is we can value it on the basis of the liabilities. The moment we do that, it is automatically equal to the value of the assets. Now here I have explained this, what I have just told you, I have explained this to you in this particular box here. So instead of repeating that, I leave this here so that you can do this on your own. Now, you look at the same thing, which is done in a slightly more detailed way. You can see this here, value of equity, value of debt, value is equal to fixed assets plus current assets minus current liabilities. You can look at it like this also. So I have created my fixed asset. These are the long-term assets of the company. I have used my long-term funds to create this. And I have also created certain current assets. I reduce the current liabilities. I get the full assets of the company, and that's it. Now, when I get this NA, basically I have to now get the intangible assets also. Now, the intangible assets, like we said before, was the brand equity, the market that the company has. There are loyal customers who will buy the goods of the company. I will add the customer relationships, the human resources, the goodwill. So you will have to put a monetary value to these things. But there are ways of calculating the monetary value that can be calculated. And on that basis, I will add that to the value of the assets. And on that basis, I will be able to get the actual value of the company. So basically, what I've tried to tell you here is that we can see different ways of valuing a company. And from the most simple ones, where we were talking about book value, liquidation value, replacement value, reproduction value, we looked at this sort of thing. And then we looked at ways of looking at intangible assets, goodwill, that part. And then we finally began to look at it in terms of the balance sheet of the company. If I take the balance sheet and now I try to value it, I will generally find that if I value the equity and the debt and the preference shares, automatically I am going to be arriving at the same figure as the fixed assets and current assets, etc. Now, this was one. Now, we'll take just a short 5-minute break so that I can just take some water and then I'll be back. Huh? Okay?
Okay, sir.
Okay, sir.
5 minutes and I'm back. Lokesh, Anjali, I'm back. Are you there? Sorry, Lokesh and Hardik.
Yes, sir.
So, see, a little while ago, we were speaking about, हम लोग replacement value की बात कर रहे हैं, आपको याद होगा.
Yes.
तो वो जो replacement value वाला concept था, उससे related, there is this model. ये देखने, नाम थोड़ा सा, इससे don't get worried about this, Tobin's Q model. इसका क्या है? They said कि what is the ratio of the market value of the firm, of the company, and the cost of acquiring assets of identical characteristics. अगर हम इसका market value आज के दिन में देखते हैं, market value हम कैसे निकालेंगे? I will look at the price of one share, multiply that by the total number of shares, I'll get the market value. बहुत अच्छी तरह आप करना चाहते हैं, आप डेट भी जोड़ दीजिए उसमें, you'll get your total market value. Now, if you take the market value and you compare it with, if you are going to replace the assets of the company, then कौन सा ज्यादा है? वो replacement ज्यादा है या market value ज्यादा है? Suppose you calculate that in theory, I can create an identical company. Land का कीमत है, जो factory बना हुआ है, I can build a factory like that. Then I can actually have machines, जिस तरह के machines हैं वैसे machines हम खरीद लेते हैं. बाकी जितनी चीजें कंपनी में है, I buy all of those things. And after I buy all that, what is the price that I have? This is my replacement value of the company. And then I look at the market value. अगर इसका value market में देखते हैं in terms of number of shares multiplied by market price, तो वो कितना है? And then I see कि कौन सा ज्यादा है. See, logically, किसको ज्यादा होना चाहिए? Market value या replacement value? Which should be more?
Market value.
Market value. So, if the market value is higher, normally it means that the firm is in possession of certain intangible assets which will provide better growth opportunities in the future. So on that basis, you can look at it like this. Suppose the market value is 10 and the replacement value is 15. Then this Tobin's Q model says, if you now look at the ratio between market value and replacement value, you will see that it is 0.67. There's another company, market value is 20, and as Lokesh said, it should be more. Here you find that the replacement value is 17. So what is this? 1.18. The third company, 25,000 is the market value, replacement value is higher, 0.83. Basically, what this means is that those companies which have a Tobin's Q ratio of less than 1, इसमें कहीं ना कहीं पे तो एक अंडर वैल्यूएशन आ रहा है कि मार्केट इज नॉट गिविंग एनी क्रेडिट टू द कंपनी फॉर व्हाट इट हैज डन. और जो इंटेंजिबल्स हैं, जो कस्टमर रिलेशनशिप्स हैं, जो मार्केट शेयर है उसका आप कोई वैल्यू नहीं दे रहे हैं. जो इंटेंजिबल एसेट्स है, यू आर नॉट गिविंग एनी वैल्यू, एंड द मार्केट वैल्यू इज एक्चुअली लेस देन द रिप्लेसमेंट वैल्यू. दैट इट इंडिकेट्स दैट द कंपनी इज अंडर वैल्यू. ये एक पॉइंट. नाउ if we look at this in the form of this, so basically इससे क्या निकलता है? The higher the better. ये अगर मॉडल से हम निकाल रहे हैं अपना, मतलब I'm trying to understand whether the company is correctly valued or not, whether the market value is appropriate or not. Ideally, if the market is accepting what the company is doing, the value, the Tobin's Q ratio is going to be better. ठीक है? This point is clear. Now we come to another way of valuation. This is generally called relative valuation. ये वाले valuation में क्या होता है कि I try to compare the ratios of this company, of whichever is my target company, with the ratios of other companies, similar companies, and then try to see कि ये कैसे कर रहे हैं काम. So let's look at this. So this is an easy way, comparable multiples. There are a quick and easy way of valuing a business. So I can look at the price earnings ratio. I can look at price to book value. Okay. So Anjali is here. Okay, Anjali, are you with us?
Yes, sir.
So you missed a little something. I'll just show it to you. Let me just show you the slide that you just missed, which was this one. So basically here we said that there is another way of trying to find out whether the company is correctly valued by the market or not. And for this, we use what is known as Tobin's Q model. So what you do is you look at the market value of the company and you look at the replacement value. Suppose you were to create this company afresh. Suppose you were to buy all the assets that this company has today and create an identical company. How much will that cost you? You compare that with the market value of the company. If the market is valuing it correctly, then generally the market value will be higher than the replacement value. Because the company is more than the assets now. The company is also about the brand equity that it has, the customer relationships it has, the intangible assets it has, the human resources that it has. इन सब चीज को लेके कंपनी बनती है. तो market, if it is valuing it at less than the replacement value, that means the company is being undervalued. या नहीं तो फिर company में जान है ही नहीं. It has nothing. Company is failing. But normally, if the company is doing reasonably well, which is why you are interested in buying it, the company will generally have a market value that is higher than the replacement value. Just a minute, guys. I think I will have to.
Sir, what did you said in Tobin's Q valuation of a company? They check the replacement value along with
the market value.
Okay, sir.
See, the market value of the company is basically the market price of one share multiplied by the number of shares which the company has. That is the basic. That is the, what shall I say? That is the market value of the company. Now, let me just show this to you. Okay, so Anjali, look at this one. So look at this example here. Suppose I take a company and I replace all its assets. I try to create an identical company. What will be the cost of that? How much will I actually pay for that? So let's say I find that I pay 15,000. And I look at the market value of its shares and I find that the market value of its shares is 10,000. That means, as far as the market is concerned, this company is not even worth its own assets. It is less than the value of its own assets. If you look logically, any company should have a value that is much more than the value of its own assets. For the simple reason that there are so many other factors that are there. For example, there is the brand equity that the company has, the customer relationships that it has. See, it has a number of loyal customers, it has human resources, and which are, in a manner of speaking, they are also intangible. So the value of that company is much more than the value of its assets. It's like that old saying where you say that the the whole is greater than the sum of its parts. The whole company is more than just the assets. It is the whole, together, the team they create, the way they work, all that gives them the business that they actually have. So the basic principle is, if I do a Tobin skew valuation, the higher the better. If I'm getting a high value, it basically means that the market is appreciating what the company is doing. You got this, Anjali?
Yes, now I get it.
So now let's look at this next thing. Now, another way of valuing a company is by looking at the, comparing different ratios that the company has with its peers, similar companies in the same industry of similar size. If you can get a group of such companies and then begin to compare what is the price earning ratio of what is the average price earning ratio, let's say, in this industry as compared with the price earning ratio of this company which I want to buy, or what is the price to book value, or the enterprise value to EBITDA. This EBITDA thing we will, and the price to book value and price to equity, we will look at this in more detail. So basically, when we compare the company with other companies, we begin to get an idea about how valuable this company is. This is the basic idea here. Now, let's take, first of all, let's just try to think of the EBITDA multiple. So the EBITDA, it's also pronounced EBITDA. I'll call it EBITDA so that you're clear about what I'm saying. Just remember, every time I say EBITDA, I'm talking about EBITDA, earnings before interest, tax, depreciation, and amortization. You know what interest is? Interest is the amount you pay for a loan. It will include the interest on bonds, any financing cost that is coming in interest. What is taxes? You know that once you get your profit before tax, you pay taxes as per the rates decided by the government. That's the tax component. Depreciation is the amount you charge on your physical assets. Amortization is the amount you charge every year on your intangible assets. So basically, when I talk about EBITDA, I am talking about the earning without taking into consideration the amount I paid as interest, the amount I paid as taxes, the amount I paid as depreciation, and the amount I charged as amortization. Basically, if you take a shortcut way, which Lokesh will confirm, it's basically the operating profit. You just add back the depreciation and amortization.
Yes, sir.
So I'm just think of it as the operating profit of the company without the depreciation. So
Non-cash expense. Non-cash expense.
Yes, the non-cash expense. So essentially what I'm basically doing here is I am trying to see what is the ratio of the total enterprise value of this company with the profit that it makes every year. So if I get that, it's also a ratio of profitability. So if I get this, I can understand and compare my company with other companies. Now, I'll show you, I've taken some 3 or 4 companies today. I'll show you exactly how this looks like with actual data. Now, what is enterprise value? EBITDA, we understand. What is enterprise value? This includes the sum of equity and debt capital. And if you look at the full equation, it reduces the cash amount. We'll come to that point. Now, when you compare this with other companies, remember you should try to compare it with similar companies. You should not compare it with companies which are, let's say, much, much bigger, so you cannot compare, let's say, a small mobile company with Apple on the ground that both are mobile companies. You will have to, any comparison has to be done with companies which are comparable, similar nature. They have, a similar amount of equity and similar amount of assets, that sort of thing. And they should be normal companies. Okay. Now, first, of course, we are looking at, let me just look at this. The P ratios, P multiple. I think something. So how do we get the P ratio? We look at the market price per share and we divide that by the earning price per share. If I know the profit of my company, and if I divide that profit by the number of shares, I will get my profit per share. That profit per share is also known as the earning per share. I can get that. I can look at the market price. I can have an average market price. And once I get this, I'm able to understand the relationship between earning per share and the market price per share. That is, for every 1 rupee of earnings that the company has, how much price is an investor willing to pay in the market for that company. Now, so this is the P multiple. EBITDA multiple I've just explained to you, include the sum of equity and debt capital. And we mentioned that it has to be a comparable group of companies. Now, what is the actual formula for enterprise value? Market value of equity plus amount of debt minus cash is equal to enterprise value. Now, what is the logic here? Logic is like this. Enterprise value is calculated by individuals who want to acquire the company. So it's basically a financing decision. The entity that acquires the company is expected to pay all those who have a financial interest in the company. The owners of the company or anyone who has a financial interest in the company. So there are two categories. Who are the owners? The equity shareholders. So who has a financial interest in the company? The shareholders and the creditors. One group is the shareholder. This shareholder is basically, he is the owner of the company to the extent of the number of shares that he has in that company. The other person who has a big financial interest in the company is the person who gave money to the company. The company borrowed from them. So therefore, these people also have a financial interest in the company. So basically, when you look at the enterprise value, you add these two, the value of the equity, the value of the debt. You minus the cash, because you will get the cash anyway. Now, when you pay for it, that cash you will get. Now, the acquirer receives the cash that the company has in its bank accounts. So it pays that much cash less to the company. So cash is reduced from the enterprise value. Suppose you add the cash back. Suppose you don't minus the cash. You add the cash, you will get a higher enterprise value. But the day you buy that company, you will get the cash which is lying there. So basically, instead of having this duplication, what you do is you reduce the cash in the beginning. You will get your enterprise value by adding together the value of equity and the value of debt. So these are the two things which are important. Now, let's take a simple example. Okay. Let's say that the gross profit of a company is basically, or let's say the profit after taxes of a company is 10,89,000. Now, if you add back the taxes, the interest, and the depreciation and amortization, you are going to get the EBITDA. You go in the reverse, you can go like this also. But if you start with the profit after tax, see, this is something which you can do. You can go to get the financial data of any company, look at its profit after tax, And then you can simply add back the taxes, the interest, and the depreciation and amortization. You will end up with the EBITDA. You've got that. If you look at the market value of the equity, in this particular case, the market price of the share is roughly is 28 rupees per share. There are 10 lakh shares. So the value of equity is this. So basically it is 280 lakhs. The debt is 25 lakhs. If I add these two together, I am getting a total enterprise value of 3 crore and 5 lakhs. So this is my total enterprise value. Now, if I divide the enterprise value by the EBITDA, I am getting 10.17. Are you following this, all of you?
Yes, sir.
Okay. Hardik, समझ में आ रहा है ये?
Yes, sir.
Anjali?
Yes, sir.
So I have got one multiple. I have found out that the relationship between enterprise value and the operating profit of the company is coming to 10.17. One multiple is there. Now, once I get this, after that, I look at other companies in this particular industry and I try to see what is the EBITDA of these companies. And then I try to compare, so how good a company is mine? Because why is this important? I am buying this company. The companies which are already there in the same line will be my competitors when I buy this. So I need to understand, am I doing better than them? Do I have a profit which is better than them? Is my EBITDA better? Is it less? See, to give me some idea about how good this company is. So this is one point. Now, suppose an analyst, he wants to know what is the value of the company. So what he can do is, he can look at, so I basically explained this here. He can try to find out the relationship between the earnings which the company has and the enterprise value of the company. So once he does this, he is able to compare it with other companies in the same line of business, and that gives him a basic idea about how good or bad this particular company is. Now, suppose the comparison comes like this. This is the company we had. No, we had a different company. These are 4 companies in the same line of business. So what I do here is, I find out the multiples of each of these companies. My company, if you remember, had an average multiple of 10.17. Now here what I'm doing is, I am taking an average multiple of, if I take all these, I look at it, then I find that the average multiple in my case is actually coming to 8.69. If I look at the EBITDAs of other companies in the same industry, I find that the average is 8.69. So what I do is, if I can also find out the value by using this average, multiplying this with the EBITDA of my company, and if I do that, I get a value of, this is the value that I will get, which is different from the value that I had before. So when you do this, this is the basic idea that you can look at it in terms of average and just try to see that this is what the value should be. If you take an EBITDA of 10.17, the multiple of 10.17, obviously the value is going to be higher. But you find out that if I look at other companies, look at their average, I find that they are actually lower. So probably a better way of looking at this is, use the average, multiply it by the EBITDA, get a comparable average multiple. See, the idea behind all this is to ultimately get more data for yourself when you sit down and negotiate at the table with the seller of the company. So this is also one way of valuing it. Now, what I did was I looked at three companies. Now, these are three companies in three different industries. So to that extent, they are not comparable. But I thought that let me use actual data, which is available. I took it from Money Control. So let me look at actual data of three companies: Asian Paints, Apollo Tyres, and Marico Industries. And I said, let me see what is the EBITDA of these companies. So what I did was I got the profit before tax of Asian Paints, Apollo Tyres, and Marico. So Asian Paints has a profit before tax of 4,194.14 crores. And so basically what did we say in EBITDA? It is before taxes, before interest. Amount of interest financing cost for Asian Paints is only 70 crores, 70.25 crores. So what I did was I added this back. And what is the depreciation and amortization for Asian Paints? It is 721.56 crores. If I add these two figures to 4194.14, I get the EBITDA of 4985.95. तो EBITDA Asian Paints का एक तरह से operating profit plus depreciation वो क्या हो रहा है? That is just short of 5,000 crores. और इसका enterprise value क्या है? I take the shareholders' funds, I take the debt, I add these two up, I am getting 14,260 crores. In one way, you can say, कितने पैसे लगे एशियन पेंट्स के धंधे में? It is 14,260.89 crores. Every year, it is able to earn almost 5,000 crores as operating profit on this base. So you get an idea about what is the ratio here. It's 2.86. That means in less than 3 years' time, they will have earned enough EBITDA to equal the total value of its enterprise. This is the range in which they are functioning, how much profit they are getting. Now look at something similar. Look at Marico. Then we look at Apollo. Marico ka profit before taxes is 1,430. If I add the interest and the depreciation, 30 and 97, I end up with an EBITDA of 1,540. If I look at the shareholders' funds and debt of Marico, I add those two together, I get an enterprise value of 3,233. Now, if I find out what is the EBITDA, it is coming to 2.10. So this is another company which is earning almost 50% of its of the amount that was invested in the company every year. In just over 2 years, it will be earning back all the money that it had invested. See so you are getting an idea now about how good this company is. And then you look at Apollo Tyres. Apollo Tyres mein, the profit before tax is just 350, interest is 382, the depreciation and amortization is 823, EBITDA is coming to 1556.42, the enterprise value is 14,876.29. What is the multiple that I am getting, the EBITDA multiple? It is coming to 9.56. So basically, it will take them, if you look at this, compare it that way, it is going to take them almost 10 years to get back what they had invested in the company in terms of operating profit. So obviously, it is less profitable. So when I compare, suppose I were to compare Asian Paints with two other paint companies, or I compare Apollo Tyre with two other tire companies, and then I look at this, I will begin to understand how good or bad my company is. And the valuation that I have it will begin to gain some meaning. Because one of the best ways of understanding the quality of what you have is by comparing it with similar things. When you make those comparisons, you are able to understand it better. Are you people getting this?
Yes, sir.
Yes, sir.
So, when, and this is something which you can do. You can actually find companies. Suppose like, for example, you can try this week, Anjali, if you get time. Look at 3 companies from the same industry. Get their profit and loss accounts and balance sheets from moneycontrol.com and try to calculate these ratios on your own. Whatever I have done here, you do the exact same thing. You'll find all the figures there for any company you choose. Just try to compare companies of the same size and from the same industry. If you do that, you will ultimately end up with some ratios, and you can interpret the ratios in the way we just discussed. So this is one way of, this is the relative valuation concept. So you understand how good is my company in relation to other companies. So that's one. Now let's look at another one, which is the PE multiple. Now, in the case of the PE multiple, like we said, that the PE multiple is actually the ratio of the market price of the share and the earning per share of the company. What is earning per share? Basically, it is the profit after tax divided by the number of shares. So I've taken a number of examples here. So let's say the profit after tax of company A is 105. The number of shares is 10. You can imagine crores here, crores here. Just to keep it simple, 105 by 10, the EPS is 10.5. The market price, let's say, is 90. Your price to equity, price to EPS ratio will be, P ratio will be 8.6. Basically, what does this mean? It means that the price is 8.6 times the earning per share. That means for every 1 rupee of earning, the market is willing to give 8.6 rupees as price. So when you have an earning of 105, accordingly, EPS of earning per share of 10.5, you have a ratio of 8.6. So now, or a market price of 90. Company B, look, the PAT is 85, number of shares are 11, EPS is 7.7, market price is 98. What is the relation here? 12.7. Every 1 rupee of revenue, the price will be 12.7. So essentially, if the market price when it is 98, what it is telling you is that the market is the market is willing to give you 12.7 times the actual EPS of the company. And then you can see the same thing for company C, company D. And if you do an average, you reach 10.3. What is this average? It is the average of all these. I get 10.3. Now, there are 2 things first of all, about the P ratio itself. When I look at the earnings and I calculate like this, when I look at PAT, when I look at previous, the earnings of previous quarters, earnings in the past, I call it a trailing P ratio because I'm looking at past figures. But if I try to calculate on the basis of the future, on the basis of projections, then I'm calculating a forward PE ratio. So that is just something to keep in mind. When obviously, if you're going to calculate something based on future projections, those projections have to be pretty good. Otherwise, it will not work. Other thing to remember here is that in these 2 variables, the price and the earnings per share, the earnings is an internal metric. It is something which the company can control. So if it really performs well, it will reflect in the profit. So it's basically internal. Let's say, manage to procure goods at lower cost. I get excellent human resources. They work very well. My marketing team does very well. I'm able to sell everything, and I end up with a very good profit. This is something which is in my control. I can take actions to ensure that I make a higher profit. Earnings per share, in the control of the company, it's an internal thing. But if I look at price of the share, the price of the share is ultimately based on the perceptions of the market. And to that extent, it is an external. So you can really perform very well. But even then, maybe the price will not reflect completely. It will reflect to some extent, but it will not reflect completely the sort of, the earnings which you have done or the sort of performance that you have. That is why when you combine these two things, you are combining both the external side, how does the market view the company, and the internal side, what is the internal performance of this company. And once you get this, you find it out for your company, you are then able to compare this with the PE multiples of other companies, and that gives you an idea about whether the market is undervaluing your company, in which case the price is very low, or the market is overvaluing the company, which means that it is much higher than the average. So that is basically how this thing actually works. So what we'll do is that clear to all of you?
Sir. Yes, sir.
Yes, sir.
Yes, okay. So we will stop with this P multiple thing here, and I have this one. You can also look at this. So I took the same three companies. I got their market price in FY22. I'd forgotten about this slide. This is an interesting slide. And I got it for FY21. When I say FY21, I am, for the sake of convenience, I'm using one date, 31st March 2022 in this case, and 31st March 2021 in this particular case. So I got the earning per share of Asian Paints, Marico, and Apollo Tyres. I got their market price and I calculated their PE ratio. So if you look at Asian Paints, this has a PE ratio of 95 in 22, 81 in 21. This is the COVID year. So their profits, let's say, would have been less. It is 81. If you look at Marico, it is 55 in 22, 48 in 21. A similar type of dip. Apollo Tyres is 46, surprising when you consider other things, and 19 in 21. So basically, if suppose these were from the same industry, we would have been able to understand exactly how the market actually is looking at the company I am interested in. That is the way to basically do it. And what I want to tell you people is that all this data is all available. ये सब है आपके पास. आप अपने मोबाइल पर ये डेटा निकाल ले सकते हैं. मनी कंट्रोल में जाइए, एक कंपनी सेलेक्ट कीजिए, you will find this data. ये अगर आप चाहते हैं पुराना डेटा इन सब चीजों के बारे में, you can use Yahoo Finance. आप Yahoo Finance पे चले जाइए, वहां पर आपको एक एक दिन का डेटा मिल जाएगा पुराना. It will help you to understand how the prices of the share prices of individual stocks have actually moved. And you don't pay anything for it. You get the whole data without any payment, and you can get the balance sheets, you can get the profit and loss statements from money control itself. Sabko leke, you can actually calculate all these ratios on your own. Why should you calculate it on your own? See, you have taken an interest in finance. If you begin to do these things on your own, what will happen is you will pick up confidence, and you will begin to understand that these ratios that we are using, what is the logic behind these ratios, how they actually work, and that will make you more confident about finance as a whole. So we'll stop here today. Next time, we'll do a bit of revision of some of these multiples, and then continue with another part of valuation. That valuation, which I think is very commonly used, the discounted cash flow. That is applying the same method which we use to calculate the value of a bond to the calculation of the value of a company. So there, I'll also explain to you the concept of free cash flows, normally how we project them, how it is done. So what any mystery with regard to those things, I think that will also disappear once we do that part. And once we do that DCF thing, we will basically understand valuation in both its, let's say, in both its guises. So number one, the asset way of valuing a company, other is the revenue way. And you will understand this. The relative valuation we have already done today. We've understood the asset side a bit. We'll complete it with revenue in the next time. Okay? Okay, then I think I'll end here.
Okay, sir. Thank you, sir.
Good night. Good night, everyone.